After hearing good things about mutual funds, many new investors want to take the next step. They try to find out which fund they should invest in. When they try to browse these websites or execution platforms, they find the choice completely bewildering because there are 1400 funds which are open for business. But if you're really confused by this choice of mutual funds, you can do a simpler thing to manage your portfolio. You can buy an ETF. In this episode of Question of Money, we'll tell you all about ETFs and how they work. ETF is short for Exchange Traded Fund. Exchange Traded Funds are funds that simply copy an existing index or an existing asset class. So, an ETF tracking the Nifty50 will simply hold all the stocks that make up part of the Nifty50 in the same proportion. Similarly, an ETF tracking gold will simply copy the gold price returns in rupee terms. The open-end fund owns a basket of stocks or assets selected by the fund manager. Every day it declares a particular NAV. When you approach the fund house to buy the fund, you get to buy it at that day's NAV. Similarly, later if you want to sell your units, you can also sell back your units to the same fund at the NAV that is prevailing at that point in time. Now, ETFs are not bought and sold with the fund house, they are instead listed on the stock exchanges. So, when you want to buy or sell an ETF, you have to have a Demat account and you need to transact at the prevailing market prices for that ETF's units. There are two differences to note here. Open-end funds can be active or passive. When they are active, which is what the majority of open-end funds are, the fund manager selects securities or assets from a large universe that is available to him, and he may be right or wrong in his calls. Whereas, in an ETF, usually it is a passive vehicle. So, it simply mimics an existing index or asset and does not require the fund manager to make active calls. The second point is, with an open-end fund, usually you transact at the NAV. With the ETF, the market price at which it is traded can vary from the NAV. So, you may end up buying a ETF at a premium or discount to its underlying NAV when you trade in the market. There is also a difference in how they work. When a fund wants to launch a new open-end scheme, it does a new fund offer or NFO, and retail investors can simply approach the AMC, apply and subscribe to the units. However, when launching an ETF, what a fund house does is, it invites institutional investors to exchange large blocks of stocks or assets for creation units in the ETF. So, suppose it is a Nifty ETF, institutional investors exchange large blocks of the basket of Nifty stocks with the fund for the ETF units. These ETF units are then listed on the stock exchange and are traded like any other share or bond on the exchange. Because there are only a limited number of ETF units available, the prices of these units can move into a large premium or a large discount relative to the NAV in the markets. So, when an ETF is much in demand, you may often see that the price shoots up well above NAV. As an investor, you have to be careful to buy the ETF only at a discount or at the NAV, but not at a stiff premium. So, what are the types of ETFs available to you as an Indian investor? There are many ETFs tracking broad market benchmarks. There are ETFs tracking the Sensex, Nifty50, Nifty100 index, as well as the Nifty Midcap 150. There are also ETFs tracking some of the sector and thematic indices. For example, the Nifty Low Volatility Index, the Nifty Alpha Index, Quality 30, Value 20 and so on. This apart, there are also ETFs available to track gold and silver prices in the Indian market. By investing in these, you can replicate gold or silver returns in the long run. There are also ETFs which are less known about, which track the debt indices. So, you can buy ETFs that track the 10-year government security, the 5-year government security, AAA corporate bonds and so on. So, all this should be enough to tell you that you can easily build a portfolio for yourself using ETFs alone. This will avoid the problem of actually having to choose the right fund manager or fund house. So, for example, if you want an asset allocated portfolio, you could put 50% of your money in a Nifty50 ETF, say 20% of it in a 5-year government security ETF and the rest in a gold or silver ETF. The mix and match is always up to you.